Welcome back to Dinar Community, your trusted hub for comprehensive insights into global currencies, macroeconomic trends, and the shifting landscape of international finance. While our usual focus centers around the Iraqi dinar, today we turn our attention to another rising player in the emerging markets, the Vietnamese Dong, or VND. In an increasingly interconnected world economy, understanding how emerging market currencies behave is more important than ever. The Vietnamese Dong has become a currency of growing significance, not just for what it tells us about Vietnam's internal economy, but also for what it reveals about trade flows, investment trends, and regional policy dynamics throughout Asia. To grasp the full picture of the VND's movement and potential, we need to examine the complex historical, economic, and political forces that have shaped Vietnam's monetary path. For investors, analysts, and economic enthusiasts, understanding the Dong means gaining insight into Vietnam's broader transformation and its strategic place in today's financial order. Vietnam's economic story is remarkable. Once scarred by war, the nation began reshaping its economic future in the late 1980s through sweeping reforms known as Doi Moi, or renovation. These policies began shifting Vietnam from a rigid centrally planned economy to a more open, market-oriented system, laying the foundation for private enterprise, increased foreign trade, and a surge in foreign direct investment (FDI). Since then, Vietnam has achieved rapid economic expansion and made tremendous strides in reducing poverty. Yet, challenges like inflation, structural inefficiencies, and external shocks have tested the resilience of its currency. Still, the Vietnamese Dong stands today as a testament to the country's ambition and economic resilience. While the Dong is often associated with high-denomination banknotes, a legacy of past inflation, that alone doesn't tell the whole story. The VND's value is deeply tied to Vietnam's export performance, monetary strategy, and the government's ability to maintain macroeconomic stability. Vietnam has adopted a managed exchange rate regime, a hybrid between fixed and floating systems. The State Bank of Vietnam (SBV), its central bank, plays a critical role in managing this system. By setting a daily reference rate and allowing fluctuations within a predefined band, the SBV helps buffer the economy from major external shocks, while still permitting enough flexibility to respond to evolving global conditions. This balanced approach has supported confidence in the Dong and enhanced Vietnam's position in global trade and finance. A strong export engine is central to this strategy. Vietnam's key trade partners include the US, China, Japan, and the EU, with major exports like electronics, textiles, footwear, and agricultural products contributing to its robust foreign currency inflows. A steady inflow of FDI has also been instrumental in reinforcing the Dong's stability. Vietnam has positioned itself as a manufacturing hub thanks to its skilled workforce, competitive labor costs, political stability, and strategic location in Asia. These advantages continue to attract billions in foreign capital annually, capital that supports infrastructure, employment, and Vietnam's balance of payments. At the same time, inflation management is crucial. High inflation weakens purchasing power and undermines currency stability. In recent years, the SBV has actively used interest rate policy, money supply controls, and market-based mechanisms to keep inflation within target levels, further strengthening the VND's credibility. Interest rates also play a vital role in determining the Dong's strength. When domestic rates rise, they can attract capital inflows from investors seeking better returns, thereby increasing demand for the Dong. However, this requires delicate balancing to avoid stifling economic growth or triggering unwanted inflation. Vietnam's increasing involvement in global trade agreements, such as the Comprehensive and Progressive Agreement for Trans-Pacific Partnership (CPTPP) and the EU-Vietnam Free Trade Agreement (EVFTA), further illustrates its commitment to modernization. These pacts not only unlock new export opportunities but also push the country to raise standards in labor, environmental practices, and transparency, thereby boosting the Dong's appeal. Looking ahead, Vietnam has signaled its intention to gradually shift toward a more market-driven exchange rate system. While this marks a significant change from the current managed float, it aligns with global financial norms and could offer greater currency flexibility. Such a shift will require strong institutional support, a stable macroeconomic environment, and public understanding of the risks and benefits involved. For investors considering exposure to the Dong, it's essential to keep an eye on key macroeconomic indicators, GDP growth, trade balances, interest rates, inflation, and capital flows. These elements collectively determine the dong's performance and can signal opportunities, or risks, when navigating this emerging market currency. Unlike major global currencies, the dong doesn't lend itself easily to short-term speculation due to its managed nature. However, it offers potential for long-term investors looking to diversify portfolios or gain exposure to Vietnam's continued economic rise. Ultimately, the Vietnamese dong is more than just a medium of exchange, it's a symbol of a nation in motion. Its journey mirrors Vietnam's rise from post-war reconstruction to a dynamic and increasingly influential player in the global economy. With the right policy execution and continued reform, the VND could become one of Southeast Asia's most strategically important currencies in the years to come. Thank you for tuning in to Dinar Community. Stay informed, stay strategic, and as always, keep watching the currencies that shape our world.